time then to bring on board a special guest. Joining in on the show this evening, we've got Mahesh Patil, who's a Co-CIO at Birla Sunlife Mutual Fund. Mahesh, many thanks for taking time out for us. You know, the last 24 hours, like Ajay and I were discussing, the macro picture has looked pretty good, whether it's CAD, GDP, even the November PMI data has really surprised on the upside. Are you getting a lot more constructive on the economy and so probably the markets as well?
I mean, we have seen a lot of negative in the last couple of years. We have seen a slowdown in the GDP, CAD elevated to higher levels. I think all of these factors, indicators are now actually at a point where we think the worst seems to be behind us. If you look at the GDP numbers after the last earlier print of around 4.4, we had a positive uptick over there. And we believe that we have kind of bottomed out in terms of our GDP growth. And we should see a slow and gradual recovery from here, to some extent aided by good agriculture, which should add a few basis points. And also exports have also been picking up around 13% or so. And on current account, definitely I think we are now at a much comfortable level than what we were around a couple of quarters back, with CAD somewhere around likely to be full year around $55 billion. We feel that can be easily funded from FDI and banking capital and ECB, even if FI flows are kind of zero. So I think that's a comfortable situation to be at this point in time. So I think clearly we feel that we have hit a cyclical bottom, and we should see a slow recovery going forward. Even some improvement we have seen in terms of new projects on existing projects, which had been stalled. There's a data, which is published on a fortnight by the Project Monitoring Group, which suggests that almost 3,70,000 crores of projects, which out of total 15 lakh projects which have been stalled, have been cleared, and they should also start incrementally contributing.
Mahesh, how are you really assessing the investing landscape right now as a fund house? Are most of the negatives priced into the market according to you?
Yeah, I mean, a year back, I think we had concerns about severe slowdown in our GDP, investments collapsing, high interest rates again rising up. So all these, and obviously current account deficit. In that kind of environment, I think the stance was more defensive, focused on companies, where there was clear visibility of earnings. And to some extent also because of rupee depreciation, I think some bias towards some of these global companies, or which are export oriented, like IT and pharma. And so we saw some of these global cyclicals actually doing better last year. But I think as we move forward, I think we've seen that some of these stocks perceived to be defensive, or whether there's a better clarity of earnings, that the valuations have moved up to pretty high levels compared to the long-term average. So given that, and on the other hand, some of the cyclical sectors like banking and financials, capital goods, they had seen a correction in wake of these concerns. So I think now with some of the domestic macro indicators kind of turning positive, at least mildly positive, and the valuation differential, we feel that probably it's time to start looking at some of the domestic cyclicals, especially where there is good value and where the balance sheets are pretty strong.
Right. Mahesh, we were discussing earlier that from here on, the best way perhaps to approach the market is by way of cyclicals. Which sectors really qualify in cyclicals according to you, where investors should hunt for value?
Yeah, so I think if you look at the best cyclical to play at the early start of the investment cycle, or the early part of the economic cycle, we have seen is the banking and financial services sector. In banking and financial services sector is a proxy to the economy, and as we see the economy bottom out and recovery, credit growth will pick up, so that should drive the sector. And also concerns about NPAs and other things which typically precipitate when you see economic slowdown. So that also started to ease off as you see a cyclical upturn in the economy. So I think you see in the earlier downturns in 2003 and 2009, when the economy bottomed out, banking and financial was the first sector actually which led the economic recovery. And I think that's a best cyclical to play at this point in time. And then later on, as we see investments picking up, which we expect probably will pick up only after the elections, capital good and the infrastructure sector are the two other cyclicals, which will catch up. But I think they'll come up with some lag.
You know, you've recently launched a banking and financial services fund in your strategy to play the whole cyclical theme. How different will this fund of yours be from some of the other funds that already exist in the market?
The fund which we have launched, it's banking and financial services sector. So it's not purely focused on the banking stocks. Most of the other funds in this sector have BankX as the benchmark. Whereas our benchmark is CNX Finance, which has banking, financial services, and some part in the other non-financial services like the rating companies or the broking companies. So I think it offers a more diversity within the banking and the financial services sectors. And we've seen the CNX Finance Index has, in the last 10 years, since its inception in Jan 2004, has not only beaten the BankX, but also the Nifty by almost 300 to 400 basis points. So clearly, I think the kind of universe which you're looking at, I think it's much broader based than some of the existing funds. Secondly, I think we feel there is enough opportunity within the banking sector to generate alpha, like how you play vis-a-vis the private sector banks and the PSU banks. We have seen a big divergence in these two kind of within the banking space in these two segments in the last couple of years. Also, there are a lot of niche opportunities which are there in the NBFC space. Companies which are focused into areas like rural finance or consumer finance, which are still underpenetrated and offering pretty high growth and high return on assets. So I think there are opportunities, and some of these companies have been able to compound their earnings at a much faster pace than the broader industry. So I think our ability to really position some of these niche areas, play between private sector and PSU banks, will help us to generate alpha and beat the benchmark. And I think that makes it really important element in terms of investing in our fund.
How do you assess the credit growth concerns, Mahesh, and also, the asset quality worries for this sector, as a large part of the market remains a bit circumspect?
Yeah, you're right. I think considering the pain what we have seen in the economy and the credit growth, we have seen a lot of stress on the asset quality. In fact, the total gross NPAs and restructured loans for the banking system is now at an all-time high of around 10% of total assets, which is kind of near the earlier peak levels. So I think there is still going to be some pain, at least for the next 1 or 2 quarters, in terms of asset quality. But we feel that we are somewhere at the peak. And again, there'll be certain banks which will probably see a lot of more pain. So I think while looking at this sector, we are still cautious and really selective in terms of which stocks or which companies we want to bet on, especially in the PSU banking space, where some of these companies not only have a severe pressure on the asset quality, but also they are also facing challenges in terms of capitalization, because they are undercapitalized and they need to raise capital, and in the current environment at below book value, they raise capital, that will really detrimental to shareholders. So we are still cautious. I mean, we'll be selective in terms of which banks, and also focus on management quality, because I think that is very important in terms of how the management is able to manage risk and asset quality in this kind of environment. So it's not like we would see secular move in all the banks. Initial period will only be selectively banks, where the asset quality is a lot of comfort. And then slowly, as we see the stress in the sector kind of abating, as we see a cyclical recovery, I think then you will see a broader participation across all these stocks in the sector.
Mahesh, let's talk about 2 key factors which are playing on the mind of the market. Markets still seem to be a little apprehensive on the entire taper talk, and also its impact on the Indian markets. But the other factor is the state elections. If the outcome is not what the populism is all about, what kind of downside risk are we talking about as far as Indian equities are concerned?
While tapering will happen, I think it might just a matter of time. I think the impact of that will be much lower than what we saw earlier. And to a large extent, when earlier tapering fear started, we saw a lot of money getting pulled out from the bond market. And anyways, we don't have much of FI investment in the bond market. So to that extent, the impact will be much muted at this point in time. And our belief is that despite taper, I think the global environment would still be pretty benign in terms of liquidity, because a lot of these developed economies, I think their recovery is not going to be that robust. So with some initial reaction, I think the market should be able to stabilize. On election expectations, we've seen some kind of expectations building up. Typically that we see that every time elections start up, the markets tend to really take a view, and there is either a run-up to the elections. And I think that is something, because the expectation is that if we get a very stable government at the center, I think then if it is reform-oriented, then the recovery, what we will see in the economy, will be much sharper and stronger. But I think our belief is that despite that, I think you will still see a a cyclical recovery from these levels, irrespective of what government comes through. I mean, the pace of recovery could be determined in terms of what kind of a government we have. So our view on the market still remains constructive. I think it doesn't change in terms of the election outcome. But clearly, I think market is started to build up certain expectations. And if the expectations are not favorable, you might see some temporary correction. The correction can be anywhere between 5 to 8% or so. But I think that should not really deter our medium to long-term outlook on the market.
Mahesh, let's talk about some other cyclical sectors, because we've been reading a lot of brokerage notes, example Citi, Morgan Stanley, etc. They seem to be getting quite bullish on the auto sector. That's also a cyclical, specifically Maruti. But when we look at overall sales number for this particular sector, it's not really been very strong. What's your call on the auto sector, where stocks are few, but they are quite widely distributed as far as segments are concerned?
Yeah, I mean, you're right. The auto sector has seen pain in the last 1 year. We've seen volume numbers either flat or declining for some both cars and two-wheelers. And it reflects the kind of slowdown in the economy and the lack of consumer confidence. But I think as we move forward from here on, I think one thing is sure that the rural side of the demand has been pretty strong, even in this kind of environment. It's the urban side which has got impacted. And I think that will continue. After 1 year of kind of a sluggish growth, we would expect some kind of a normalcy to come back over there. And next year, I think the volume growth, if the economy recovers, that will continue. Of kind of a sluggish growth, we would expect some kind of a normalcy to come back over there. And next year, I think the volume growth, if the economy recovers, and if we see some moderation in interest rates, I think then the uptick in volumes could be much stronger than expected, because typically these are consumer discretionary segments, so there is kind of a deferral of buying, okay, which happens. So there is some pent-up demand which is there. So when there is a slight recovery or confidence comes back, the kind of growth which we see in the initial period of the downturn is much stronger than the normal trend line growth rate. So given that factor and the fact that a lot of these companies have been able to really cut down their costs in this current slowdown and bring in efficiencies, which was reflected in the last quarterly numbers, where we saw the actual margin improvement despite volume being sluggish. So I think as volumes pick up, you will see the operating leverage coming into play, and that should drive earnings growth. And most of the companies have very good, decent return on capital employed, and the valuations are pretty reasonable. So I think as a consumer discretionary space, and as we see slight upturn in the economy and consumer confidence coming back, this sector should do well in the next 2 to 3 years time frame.